Hi everyone. Welcome to our podcast. So today we have TN from Pendle, who joined us to tell us about all the exciting things that people actually do in DeFi. My name is Evgeny from Re7 Capital. We are a stablecoin central DeFi fund, and we're very excited to have this chat with TN. Before we start, just a quick note that nothing in this podcast slash webinar is considered to be investment advice. It's purely for informational purposes, and it's only designed for professional investors anyway. So with that, Tian, welcome. It would be great for you to introduce yourself and tell us about your journey and how you got to this crazy space.
Yeah, thank you for having me, Evgeny. So to get started, I think my journey into crypto actually went back as far as 2014. So I first learned about the concept of crypto and blockchain through a research project that I was doing for a professor. So at that point in time, I was serving as a research assistant, and I was tasked to look into the different business models that exist in the fintech space. So I looked through a couple of business models, and one of them stood out to me. And this company, presently, I'm not sure if it's still around. It's probably folded already, but it was a remittance company that uses Bitcoin as a tool for the money transfer aspect, right? So basically, it's a very simple concept. It specializes in the Singapore-Philippines corridor. And basically, from the one side, say if you're a person in Singapore, you want to send money to the Philippines, you would buy Bitcoin through this company, and then the company will liquidate the Bitcoin to peso in the Philippines. And that's kind of how it's done, right? And I thought, after looking through several of these business models that specialize in money remittance, I thought the one that uses Bitcoin was very, very refreshing. So because like everyone else was kind of using the Hawala system, but Bitcoin was a different proposition altogether. So that piqued my interest, and I decided to go deeper into it. So looking back, this was all in 2014, right? It was pretty much the beginning of it, because after that, I started to dive deeper into the crypto space. Again, this was all in 2015, 2016 period, where there was practically very, very minimal discussions around this particular technology. But for me, I started, one of my first involvements in crypto, right, was to set up the community group on Facebook. It's still around, but it's just very inactive right now. It's called like Ethereum Singapore Facebook community. So I was managing that, and I was just just looking through the different kind of materials that I could find and share with the community. Again, because I wanted to learn more about the technology, because I was fascinated by the promises and the potential. And I thought that I needed to equip myself with more knowledge in this particular domain. So through that, very fortunately, I got to know Loy, who is the co-founder of Kyber, and we befriended in around 2015, 2016 period. But fast forward about a year and a half later, when he started Kyber, he also invited me to join the team as a founding team member. And that's how like things unfolded. So Kyber was a very pivotal moment for me. It was I think it was one of the best decisions I've made. Learned a ton over there, met a lot of very smart, educated individuals who have very high regards for the technology, right? And learning from these individuals had been a very, very good experience for me. So that was the very beginning of it. But ultimately in 2020, at the end of 2018, I decided to move out of Kyber to get more exposure outside of the Kyber and Ethereum ecosystem. I wanted to learn more about the different kind of technologies that exist in the space. I wanted to learn more about mining, because mining is such a critical component of the entire crypto space, right? And I wasn't getting enough exposure in that regard. So, after very serious thinking, I decided to step away from Kyber, and I set up a small shop just to work on consulting projects. And this was when I assembled a team of people who are now working with me at Pendle to explore different avenues. So, like put it simply, right? I think the 2019 and 2020 period had been very, very instrumental for us because it was a very good time for us to learn about the industry on the one hand, but also to allow us the time and opportunity to work with each other and recognize each other's strengths and weaknesses. So I think the 2019 and 2020 period served as a very good foundation for us. And subsequently, in 2020, DeFi summer happened, right? And we were
before we jump to the DeFi summer. So Kyber, obviously, just looping back into Kyber for a second. So it's obviously one of the first original decentralized exchanges, right? That allow you to trade, leaving aside all the brokers, all the custodians and all of that. So it must have been the first kind of DeFi project around, or one of earliest three, I guess, right?
One of the earliest ones. Yeah, so you're right. And because like the entire concept came about in 2017, so decentralized exchange is not a super new concept. It's actually been around, and it was actually one of the most important ideas that everyone was talking about back then, right? But one of the things that I realized after working in crypto space for a couple of years now is that some of these ideas, when they first emerge, they usually seem like they're ahead of time, as we've seen, right, with decentralized exchange. So again, I think the decentralized exchange discussions happened in 2017 or even earlier, but it wasn't until 2020 when DeFi summer really happened, where we saw like significant surge in adoption and trading volume on decentralized exchanges.
So what changed, right? So we had the 2017 cycle, the crazy ICOs and all that stuff, then the bear market. So what do you think was the trigger for that insane adoption that pushed, value in DeFi to go from a few million to hundreds of billions?
I think it's a lot of things, and it's very difficult to pinpoint to a single factor. But I think ultimately, if we look at it right at a high level, I think it's just user education and awareness. And then we have a catalyst that kickstarts the entire cycle. So, going back, decentralized exchange, when the whole concept started out, let's say in 2017, when there's Bancor, 0x, and an AirSwap, these platforms, the user experience was pretty intimidating, realistically, right? And this was when MetaMask was just getting started in a way, right? And users are still trying to understand what it means to have private key and public key, and how do you even safeguard your private key from, like exploits online. Mm-hmm. So this was the kind of environment back then. And when you're so preoccupied with safeguarding just educating yourself about the security of the technology, I think it's very hard for you to focus on what's ahead, right? So that's one aspect. But over time, as the user experience of these very important infrastructure in crypto and DeFi improved, I think people became more comfortable. And of course, like a big catalyst happened in 2020, right? And this was when most of the decentralized exchanges are seeing 800K, $1 million of trading volume per day. So what happened was in 2020, DeFi summer happened. So Yearn happened. And then I remember pretty vividly, Yam Finance also kickstarted a new kind of trend. And then Yam happened, Ham Finance, whatever food you can think of, there's a token for it.
I mean, sushi is obviously there, but
yes, sushi.
Obviously we have pickle, we have I
yes,
think we have pizza, we have bao, we have burger swap, and many all the food
kimchi.
from
yes. And I thought this is a very interesting phenomenon, right? Because some people, obviously some developers, they have malicious intention, but I think a number of them really wanted to experiment with this idea, and it made sense for them, right? After issuing tokens, they want to make sure that the token is tradable, and so that there's a price discovery mechanism. And I think this is where decentralized exchanges excel. because you couldn't expect Binance or OKEX or Huobi or Coinbase to list a food coin immediately, but the developer could, just provide liquidity on any one of these exchanges very, very readily, and just get the token to the hands of whoever wants it.
Yeah, for sure. And then at the end of the DeFi summer, we had basically decentralized exchanges, insurance, banking, i.e. lending, even some basic derivative stuff started to emerge. So that, naturally brings us to Pendle. So as you were looking at the DeFi summer, how did you come up with your idea, and what is your idea? So now is would be a good point to look into that.
Yeah, so for us, because we had been participants of the DeFi summer, so we were like our team, we participated in a number of these food coin projects. So food coin projects, I think one of the best things about these projects is that the APY, when they started out, they were extremely high. So maybe not nearly as high as what we're seeing with the own forks these days, right? But back then, well, 10,000, 20.
We used to see, not anymore. Right now.
Yeah, not anymore. Yeah. But like 10, 20,000% APY or even more, it was a norm. Yeah. And as much as we like the idea of having very high APY, the APYs were constantly fleeting. So it was very common, right, for you to put money into one pool, and then 2 days later you have to move your funds to a new pool because the APYs don't make sense anymore. And it so happened that someone else created a new protocol, and you have to be there as soon as possible. So we recognize that this is really one of the things that could make people uncomfortable, because I think it's human nature to want certainty. But the ability to have that kind of certainty was largely absent in the crypto space. And at the same time, we reference what we witness in crypto to the traditional finance. And we realized that fixed rate products are probably one of the most important product sector in the traditional financial landscape, right? So that was absent in crypto. And effectively, that was the motivation for us to look deeper into this problem statement and devise a solution that to enable a solution for that.
So what does Pendle do?
Yeah. So at a high level, I think Pendle is a way for users to tokenize and trade yield, right? At a very using an example, right? When users participate in DeFi venues, whether it's a money market, whether it's a decentralized exchange as a liquidity provider, or yield aggregator like Yearn or Harvest, these participants are entitled to yield, or like the APYs. Now, the thing is, with all these different venues, the APYs are constantly fluctuating. So there is no certainty to the kind of APY that you could expect as a liquidity provider. Like, you might have an estimation, right? But you don't know how much you're getting for sure. Yeah. So this is where Pendle enables a fixed rate, right? So fundamentally, Pendle's source of liquidity is the yield-bearing assets from these DeFi venues. Now, when you participate in DeFi venues, when you contribute liquidity to these platforms, like say Aave or Sushi or Uni, you will be getting yield-bearing assets in return. So the yield-bearing assets will serve as two functions. One is it serves as a proof of your deposit into these platforms, and secondly, it functions as a certificate of sort, right, to accrue the yield. Yeah. So now what Pendle does is to split up these two functionalities and represent them in two different tokens so that they can be traded independently. So as an example of a use case, right? Now, let's say if you are a liquidity provider into Aave pool. So you contribute USDC into the Aave pool and you get AUSDC in turn, right? So the holding of AUSDC actually entitles you to interest rate for as long as you hold it. Now, let's say your holding duration is 1 year. You will be getting, as of today, maybe conservatively speaking, right, 2% per annum. if your view of the APY is that it will go down below 2% in a year's time, then but now you don't have a way to express that view. But with Pendle, you can actually sell away that yield and take the money up front. So this is a mechanics for lenders to get the fixed rates. Now on the other hand, someone else who believes that the APY of AUSDC could be as high as 10% in a year's time, then the Pendle provides an avenue for them to get an exposure, speculate on it, in a more capital efficient way.
So this is basically interest rate swaps, right? And kind of zero coupon bonds. So you basically are kind of creating a whole new asset class, right? That sits on top of the DeFi protocols that exist today.
That is a good way to put it. I think of it as a second degree derivative that will only make sense when the underlying primitives like the money markets and AMMs exist.
Yeah, obviously, because you're building on top of them. So definitely, in the traditional financial markets, interest rate swaps and similar products, retail users don't normally engage with them beyond some very, very crazy speculation, right? Most of it is pension funds, corporate treasuries, investment banks and all of that stuff. So what has been your experience with launching and kind of developing these products in DeFi? Does the average DeFi user care? Is it mainly institutions who use your product? Is it retail users? Like, do you have any visibility into, who uses the product and what has the overall traction been since you launched?
Yeah, so I think for now, bulk of our users are still retails, but they are a bit more sophisticated. So I think we've been operating the product for a little over 7 months now. In terms of traction, right, we're seeing about 100. We just exceeded $100 million in the trading volume of both OT and YT a couple of days ago. So on the 1st of February, we exceeded $100 million in the trading volume cumulatively, right? I think a bulk of it actually happened after December when we launched a specific market pertaining to Wonderland. So red memo, yeah. But before that, we started out on Ethereum and we supported assets from Aave and Compound and Sushi. So 3 of these platforms, we've got several assets from these platforms traded on Pendle. I think the fact is, as a interest rate derivative, the strategy component remains to be rather complex and complicated for most retail users. They couldn't care enough, right? Like most retail users would just follow guides from influencers or YouTube, and they don't really go deep enough. Most of them wouldn't have the capacity to go deeper and try to understand the mechanics behind all these tools. And I think when we started out with some of these more, say, like blue chip assets, because the APY is relatively low, we're looking at 20% per annum. It doesn't really entice users to participate and speculate in this market. But things change when we introduce a very high APY asset in the form of red memo, which at its point of listing had about 80 to 90,000% APY. Now, so that means a change, like even a change in the underlying, which is time, right? The change in price of time could have an aggravated impact on the APY. So let's say, I don't remember the exact number, but let's say if it goes up like $10 or 10%, right? The APY could go up, say 10,000%, something like that. So that is a very interesting asset, because like when we were thinking about the ways to iterate the product, because like, to tell you the truth, transparently, I think we're still in the process of figuring out the product market fit. We think that there is potential for this product, and we think that eventually, as more and more people get yield exposure through all of these DeFi venues, they will have to manage their yield at some point in time. And we can be one of the tools for users to manage the yield. So that is the longer term belief. And so looking back right now, I think we're still trying to identify a meaningful product market fit, which is why we're doing a number of iterations and just continue to build on top of what we already have. So high APY assets was one of the things that we have always been very interested in. Again, because this discussion stems back to our partnership with Olympus Pro. And because we're one of the first projects to be featured in the Olympus Pro program, alongside Alchemix, StakeDAO, and a few others. So we thought about Olympus as a potential asset to support. Now, the challenge back then was that Olympus was largely still on Ethereum, and Ethereum, look, Pendles contracts are very computationally intensive. So at that point in time, ETH was trading at around $4,500. So the gas, yeah, good old days. Just a couple of weeks ago, actually.
Yeah.
Yeah. So it was very expensive for traders, and we didn't think that getting users to trade interest rate on Ethereum would make sense because the sunk cost was very hefty. So we looked at an equivalent on Avalanche, which by then we already have some traction and visibility. And Wonderland happened to be a very good fit for us. 80-90,000% APY was very, very attractive for a lot of users. And because any change in price in the underlying could have a pretty aggravated impact on the APY itself, then users become incentivized to learn about the mechanics. Because I remember that shortly after we released the market, we announced a piece to explain how a user managed to increase the APY from 80,000% to 240,000%. So that piece actually was pretty well circulated, and we saw a lot of users from Wonderland replicating the strategy and trying to learn more about the interest rate swap aspect. So
when you moved, well, not moved, because obviously, you launched on Ethereum, you're still on Ethereum, but also you have new markets which are being launched on Avalanche. So what would be the average transaction cost, not in terms of the fees, but in terms of the gas costs on both of the chains, just for us to understand the difference in the magnitude of the costs?
Sure. So I'm actually not too sure about the cost right now on Ethereum, but at its peak in December, it was around $1,000 end-to-end transactions. So meaning to say, like, if you want to
in gas costs,
just in gas costs, yeah, comparatively, end-to-end transactions on Avalanche costs about $2.
And that's why Ethereum is losing market share.
Yeah. Other rivaling chains or like other layer ones are gaining traction. I think a large part of it was because new users couldn't afford the gas, right? And yeah, it makes sense for them to explore newer grounds.
And going forward, will you be prioritizing Avalanche or some other EVM compatible chain, or will you be building mainly on Ethereum, or will it be both? Like, how, from your perspective as a builder, which chain do you care about?
Yeah, so I think from the perspective of builder, and again, from the perspective of the builder, it's actually very simple. We have to respect the users. So ultimately, the decision making boils down to users. And from a user standpoint, and looking at the statistics, the numbers that we've gathered so far, we see significantly more activities on Avalanche as compared to ETH, right? So just some examples. We launched a Z function on Avalanche in December. And recently, we also introduced like a single token liquidity provision. Basically, that means you could, as long as the asset is supported on Trader Joe, you could deposit the asset and provide liquidity to the pool on Pendle, the pool of choice on Pendle, even though you don't have the prerequisites. So I think now we're seeing on average about as of last week, we're seeing about average 50 to 60 transactions per day. Just providing liquidity. This excludes the swaps.
That's a lot.
Compared to, sorry?
That's a lot.
It's a decent traction. Again, because of the red memo, the red memo markets, right?
Yeah.
But you know, comparatively on Ethereum per day, it's around like 2 or 3 at best. Yeah. So it's really because like when you take the gas consideration away, and when we improve the user experience through some of these newer features, I think it makes a lot. It just makes user more comfortable in trying out the product and really learning the mechanics of it.
As a user who is looking to use the product, you know, obviously they're saving a lot on costs. Are there any downsides to using different chains versus Ethereum, or not necessarily?
I think by now it's actually not it's not that apparent. Like, of course, like Ethereum is like the flagship chain, right? It's got the it probably has the most vibrant developers community, because it's a few years in the making, and that in itself is very, very difficult to displace. But I'm also seeing more and more innovative products on Avalanche, and not just Avalanche, right? But other chains as well. The go-to-market strategies have been like pretty interesting. I think very highly of Terra. I think Terra has been doing the right things, you know, like for a while. But of course, like recently, the market shook a bit, and everyone's affected. But in general, I think the go-to-market strategy from the Terra side of things has been pretty impressive. You know, similarly, I would say the same for Avalanche as well. They are so aggressive in acquiring new developers to build products on the Avalanche chain, and we're seeing a lot more activities these days.
Fair enough. And if we take a step back from Pendle for 1 second, so I'm sure some of our listeners know what Wonderland is and Olympus, but I'm sure to all normal people, 80,000% APY, 80% annual yield sounds like too good to be true, or delusional, or DeFi crazy. So, you know, can you just briefly summarize, you know, what do these projects do? How are they able to pay that much yield, and what's the catch?
So I think we have to go back to the OG, right, which is Olympus in this case. And Olympus narrative has always been protocol owned liquidity. No, meaning to say, like, I think the vision is noble, and I like what they're proposing to the crypto community. Again, because a big part of crypto, right, is liquidity incentive. Like the farming activities happen because users are providing liquidity in exchange for incentives, and these incentives are typically in the form of platform tokens. So upon the reward, right, users can choose what to do with it. They can either sell it away or hold it if they really believe in the prospect of the protocol itself. So at some point in time, as the platform becomes more bigger and bigger, the continuation of this liquidity incentive can be quite costly to the protocol, because they are renting liquidity, and Olympus came about to flip the narrative in suggesting that protocols can actually buy over this LP positions and own that liquidity itself. So here the exchange is actually pretty straightforward, right? Let's say you are a liquidity provider of my token on Uniswap. You have the LP token. So what I do is I will come to you and I make you an offer. I say, okay, I'm going to buy over your LP position on Uniswap. In exchange, I will give you some of our platform tokens at a discount, right? So if you're agreeable, and this is what bonding is all about. You're giving me the LP token, and I'm giving you the platform token in exchange. So the bet here is that the amount that the LP token can generate over time exceeds the incentive that's given out, right? So this is the narrative. It's very sound. I think, from a protocol standpoint, it is really costly to try to continue to pay out incentive for an extended period of time, especially when the liquidity has already thickened. And if there are more and more participants, and assuming that the token price remains stagnant, it can be pretty costly. So owning that protocol liquidity is a sound narrative. And so this is the narrative, right? In terms of the mechanics, how they derive that, say, 10,000%, 20,000% APY, that's got to do with rebasing. And basically that's almost like printing of new assets. Every maybe a couple of times a day, depending on the protocol, the way they set it. And that rebasing, along with compounding, you can get to 10-20,000% easily. So
I like
that yeah. So I think, like there isn't so much of a catch here, right? The catch here is really I think the mechanics is pretty straightforward. It's rebasing along with compounding. So the catch here is if you back the wrong protocol and you get rug pull, as with any kind of farms, you will lose the value of your holdings.
Yeah, exactly. So easily, but not risk freely, right?
Yes, that's not risk free. Definitely not.
So if we go back to Pendle, one of the things that I'm personally excited about when it comes to DeFi is that because the code is open, everyone can build on top of each other, right? So you can take this lending and money market protocols, and you can build basically an interest rate market on top of them. Like, could someone come and build something on top of you? Like, how could this product evolve into something that we can't even foresee? So we'll be curious, to see how you think about composability and obviously your own roadmap.
Yes, so I think it's a very fascinating thing that you brought up, because I think composability is really one of the biggest propositions of DeFi, and we are actually just part of that bigger pieces, right? So we're building on top of another product, and that is built on top of maybe another product. So I think how I envision the assets or Pendle could be used as an underlying protocol for other newer protocols to build on top is potentially in the form of structured products, right? Like, because OT and YT are effectively they're coupons.
So
OT
sorry token and YT is the yield token, right? So
that is correct.
So you take an interest-bearing asset that you can basically strip out the principal and the future yield.
Yes, that is correct. Yeah, so if you have like a basket of different yield tokens, it can be meaningful in its own way. So from a user standpoint, you can gain like different exposure of different assets through just one of these products. So that's one, right? Like an ETF or a mutual fund kind of concept. And then secondly, I think there's also the potential for someone else to write strategies to capitalize on the protocol. So for example, what we're seeing right now is options landscape provides a pretty good case study for us, right? Options is not the most accessible product. It's also not the easiest product to understand. But in crypto, the access has been democratized. But even then, because of the complexity of options trading, I think a lot of users shy away from the product itself. So here comes vaults like Ribbon, Data Nodes, right? Staked out. They write strategies to allow for users to get exposure without really having to understand what option is. And I think that is potentially an avenue for growth, right, in the fixed yield landscape, because again, interest rate derivative is not the easiest for users to comprehend, but there presents some opportunity here for users to capitalize on. And if they have capital, they I think it makes a logical sense for strategy writer or trader to write a strategy to help bridge this gap. And that's another way that I think how landscape could potentially evolve. And because right now we're seeing more and more fixed rate products emerge. So aside us, there are also a couple of other products that are new and emerging. So a strategy vault can potentially be neutral and just have exposure in across all of these different protocols, and then provide a pretty good opportunity for users to get some exposure without really having to understand the nitty-gritty and the details.
Yeah, I do agree that when you can take and package a financial payoff into a code, and then you put a front end on top of it, and all people need to do is click one button without talking to anyone, that obviously they should know what they're doing. And to be fair, some people I'm sure don't necessarily know what they're doing, but as a fundamental piece of innovation, that's obviously pretty cool.
Yeah, you look at the number. If you like the APY and you're comfortable with the risk, you go ahead, right? And then the rest is luck.
Pretty much. And yeah, actually, on this point, actually, so at our firm, we built a bunch of data infrastructure to track the real APYs and the real numbers, because what I personally find very interesting is that more often than not, the data you're seeing on these websites is actually correct, but it's usually backward looking. So you kind of know what the APY is, but you don't really know what the yield is, right? So it's interesting. And what we see is when you, to your point, when you don't, as a user, when you don't see that, juicy yield number, very few people would go in there. Whilst actually, if you kind of look at the code and you understand what's going on, actually you realize that the future expected yield can be much, much, much higher. But no one is there because they don't see the number on the screen. So it creates, I think, the gaps, between kind of professional and just kind of an enthusiast, so to speak.
Yeah, fair.
And in terms of your roadmap, so what's the things that, your work, like what are you spending your time on? What does your team spend time on? What can we expect from Pendle over the next year?
Yeah. So I think a large part of it this year, one of the priorities for us is to improve the user experience. Again, I think we've tested some hypotheses. If the APY is reasonably high, there is an appetite for a product like ours. So what we want to do is to really simplify the process and allow greater accessibility for users to participate in our protocol. So that's one, right? I think right now, if you visit Pendle, unless you understand the YT and OT concepts, it can be quite intimidating. So the goal here is for us to abstract the concept as much as possible so that users can trade yield or get some exposure without having to understand what happens at the back. And I think this is relevant for both the retail and the professional traders, because I think no one would refuse a good user experience. They can maybe some professional or institutional investors would want that flexibility to customize, but they will never refuse a good user experience. So this is one aspect, right? The improvement in the user experience. I think we're also looking to support more of these like high APY assets. So, ultimately, we've seen pretty promising tractions, organic growth in Red Memo. So we are currently like scouting for newer assets to support. So again, I think to your point, this sector has lost a little bit of its shine, right? Because for a while, all forks were the talk of the town, and everyone just wanted to get some exposure there because it was up only. But now with Wonderland, with Olympus, the recent plunge in the prices, I think a lot of people are more cautious about participating in these different avenues. So I think some of these protocols will cease to exist, but the ones that continue to exist would be a very good target for us to support. And also, I think this year we can expect V2. So basically, version 2 of the product that we are launching, it will it will consolidate a lot of the findings that we've observed over the course of the last few months of operating Pendle. So we are looking to incorporate these learnings into the newer products so that we can improve the user experience and just be more holistic in general.
So give us some alpha. What do we need to pay our attention to? What is the one thing that everyone should be super excited about when it comes to Pendle?
I think it will be a lot more capital efficient to trade the YT and OT. There is, and the protocol will capture more of the value. So one more thing is like we're also looking to introduce token mechanics as well, because for a long time the token exists without a good utility. So we're looking to change that pretty soon.
Nice. That's actually an interesting point that I've seen happening more broadly in crypto and in DeFi specifically, that as you have the bull market, then many tokens, they rise and fall depending on the popularity and what have you. And especially in the early days, projects often launch tokens because you need to have a token, because otherwise you don't get the traction. And then it's interesting to see that over time, because these tokens, they're obviously, well, some are not securities, but the beauty of them is that they can represent any utility that you want them to have, right? So some of the tokens, they can underwrite the like stability pools and be a risk buffer, like a lender of last resort. Some of them basically pay you dividends. Some of them can be used for staking, blah, blah, blah. So it's pretty cool to see how different projects go down different paths and use their tokens for different purposes. And as the markets become harder, people have to be more and more precise about how to utilize their tokens specifically.
Yeah, I think to your point, right? It's very fascinating. There's a lot more emphasis on this particular aspect, as far as I can tell, more so than previously. So and token economics has always been a very fascinating subject because there's always a trend, right? For a while, I think synthetics pioneered a kind of model that a lot of other projects follow suit, and then these days, Curve, the V model, is again like the highlights, and everyone's just building on top of it. So it's very fascinating to see how some of these can be affecting certain directions in crypto and DeFi altogether. So I don't know like the next steps for these protocols, but very, very fascinating to see the evolution.
Agreed. And as we wrap this up, what would be your one prediction for DeFi for the next 12 months? What will happen in DeFi?
Yeah, so I continue to believe in under collateralized loans. And I believe that we are going to see significant improvement in this particular aspect this year, because last year I was actually expecting this to happen last year, but so we've seen a number of projects that specialize in under collateralized loans to take place, and I think to a large extent these products have shown very promising traction. So my belief is that this year, if the traction continues, and with the participation from large institutions, from just traditional finance in the crypto, I think these platforms and avenues will likely see a growth in adoption. So I'm actually pretty optimistic about under collateralized loans in crypto. So I would pay attention to it, and hopefully some of these assets will outperform the growth in the market.
Nice. I agree. Actually, I think the under collateralized loans are one of those things when once cracked, they can really help DeFi scale, 10 or 100 or even more X. I think you're spot on. I think that's a very important.
We're paying too much to borrow these days.
Well, DeFi. I mean, DeFi is not extremely capital efficient right now, neither on the trading side nor on the lending side, which is fine because you need to start somewhere. But we need to crack these cases and just keep growing.
Yeah, maybe another prediction, less serious prediction is like maybe we might see another dog coin in top 20.
I thought you might say that. So
We have two now, right?
the real
Shib
challenge is to forecast which breed of dog it will be.
Corgi.
Yeah,
Corgi.
why not? Why not? But yeah, it is entirely possible. Yes.
Yeah,
It is entirely
I've learned. I mean, like from my friends with no prior experience in crypto, dog coins are probably one of the few things that they know about crypto.
really.
Yes, they know Doge, they know Shiba. Yeah, from all these different platforms, social media platforms.
So can we expect for you to tokenize Shiba, and then ears are separate from the head and that sort of thing?
Well, that would be challenging because it is still a very like we don't want to dissect the animal that way.
Yeah, probably not.
Yeah.
Well, less serious note. Thank you for joining us. Thank you for your time. It's fascinating to see how DeFi is growing in terms of its composability, maturity, and everything else. And yeah, we'll be keeping an eye on what's going on and excited for the next year.
Yeah. Well,
Thank you.
thanks a lot for having me. It's been a pleasure chatting with you.
Yep. Speak soon.
All right. Cheers.